StreetEasy is partnering with local real estate expert Deanna Kory, a senior vice president at Corcoran, to answer some commonly asked questions we hear from buyers looking to purchase their first home. How should a potential buyer read a building's financial statement?
Well, it's a very good question because a lot of buyers do want to read financial statements, and I typically say read them, but know that it's a starting out point. It's not the end story. And at the end of the day, an attorney who's used to reading these financial statements will have most of the answers. So it is a basic overview. It gives you a quick glance into what's going on in the building. And you should know also that it is typically a two-year financial statement. So it's something to think about because you'll be able to compare and contrast one year to the next.
So let's talk about the balance sheet. Can you break that down for us?
Well, the first section of a balance sheet typically shows the assets and the liabilities section. And in the assets section, it will talk about the value of the building, which doesn't have so much relevance. But it will also give you information about the reserve fund in the building. That's listed in different ways. It's sometimes called cash, sometimes called working capital fund. It has many different names. It will also give you an indication about if there are arrears in the building, if there are income from any other sources, say a gym in the building or a store that the building may own, things like that. So you'll get that information there. In the liabilities section, if it's a co-op, you're going to get the information about the size of the mortgage and if there's an additional credit line. And in terms of a condo, some condos are taking out loans, so you'll see the loan in that liabilities section.
And what about revenues and expenses?
Well, the next section typically is that, and that's a very important section because you'll see what they're bringing in for their maintenance or their common charges, and you'll be able to compare and contrast the 2 years, so you'll be able to tell more or less what the increase was from one year to the next in terms of percentages, like a lot of people would like. So if you're talking about, say, 2010 versus 2011, say, for example, and one year they brought in $300,000 in maintenance charges, next year $330,000 in maintenance charges, you can then see that the maintenance went up approximately 10%. In addition, it's going to show you, again, the other revenues, and then at the bottom, you'll also see the expenses. So you'll see what they've been paying, and you'll be able to match whether the revenues are meeting the expenses or whether or not they're operating under budget or they're going over budget. That will give you some clue into how the building operates. The last section on that page typically shows accounting passive losses like depreciation, and you'll be able to see those and you'll see very big numbers, but do not be afraid of those. It's a big thing that people will look at and focus on, and it's really an accounting passive loss. It's not a cash loss, so don't worry about it.
So what are some potential red flags that a buyer should look out for?
Well, in the expenses and the revenues section, you want to look and, as I say, compare and contrast. So there may be 1 year where, say, one expense was much higher than the year before or much higher the year before than this current year. So like a legal fee might be something that if you see a huge legal fee all of a sudden, that may indicate that there's been a lawsuit or something happening in the building. Or if you see a huge repair budget, you're going to want to know what's going on in that building because there were a significant amount of repairs that needed to be made. So those are just questions. I wouldn't say they're red flags specifically, but there are questions that require additional answers.